It's incredible to see how generous people are with the causes that they care about. But if you're just writing checks to charity at your checking account, you're probably missing out on massive tax and financial benefits. As a certified financial planner, I review hundreds of high-income tax returns every single year, and consistently I see that people are making tremendous donations but receiving zero tax benefits for them. With the standard deduction being as high as it is today, simply writing a check often doesn't move the needle on your tax bill. We're here to change that. By building a coordinated plan around your giving, you can have the exact same impact to the charities that you care about while also receiving a tax deduction at the same time. It's called a donor advised fund, or DAF. It's a unique tool that allows you to take a major tax deduction today while giving you the ultimate flexibility to distribute money to your favorite charities now or over time. In the next few minutes, I'm going to show you how thoughtful, proactive planning can maximize your impact to charities and optimize your tax savings today. Let's get into it. So, first and foremost, what is a donor advised fund? Simply put, all a donor advised fund is, it's a special brokerage account that can only be used to benefit charities and 501c3 organizations. That's really all it is. You have complete flexibility with how much money you contribute into it, but most importantly, who gets that? What charity gets that, whether it's today, next week, 5 years down the road. And two, you've got flexibility on the investment side of it. So we can get it invested to be conservatively, we can get it invested to grow and, really accelerate what can go to the charities. First and foremost, no matter what is most important to me is that we're benefiting charities. No matter what. Any dollars that we put into this, whether it's through appreciated stock or just straight cash, the charities down the road still get the exact same pennies. So the common question that I get a lot is, what are the best assets to put into it? The most common that I see are either using cash or appreciated securities. And by appreciated securities, those can either be stocks, they can be mutual funds, they can be ETFs or exchange traded funds. It's a lot of flexibility. So to use an example, when this really works the best, let's say a long time ago, you purchased $100,000 worth of stock. It doesn't matter which one it is. Over the years, that has now grown to $200,000. Okay. So if we were just to sell and use those cash proceeds and give them to an organization or to a charity, we would first have to realize a $100,000 capital gain. For most families that I see, they're in either the 15 to 20% long-term capital gains tax rate. All this means is for us to be able to sell this, if we weren't being more strategic about it, we would have to pay $15,000 to $20,000 on average in federal taxes on that, obviously leaving less money. Charities don't pay taxes. So instead, what we can do is just gift those shares or that stock or that mutual fund into that special donor advised fund account. The beauty of this is it completely avoids this 15 to 20% capital gains tax, which means you as the donor avoid the capital gain. It will not show up on your tax return. That's one of the big benefits there. The most unique strategy and how we can really make a big difference here is using that in tandem during high income earning years. So for any dollar amount that we put into this donor advised fund, we receive an 100% write-off against our taxable income. To be fair, there's income restrictions, so we need to talk to a fiduciary on it, but it's a huge deduction. So in this example, let's say that we did donate $200,000 into this donor advised fund this year. It's a $200,000 write-off on our ordinary income for whatever other income source we have, whether that's a liquidation event from bringing money from another country, whether it's from selling a business, or two, what we like to do a lot with our clients is take a forward-looking approach to the tax liabilities within their accounts. A very common way we do that is through Roth conversions. So if we're doing a Roth conversion, typically that's going to, and let's just say, hypothetically, we do a $200,000 Roth conversion. Typically, it's going to add $200,000 of income here. If we're using that in conjunction with the $200,000 deduction from this, we strip that away. So from the IRS's perspective, that Roth conversion shows up as a zero on your tax return, which just means it's a free $200,000 Roth conversion instead of paying 22 to 24% tax. Where I see it make the most sense in practice is for people who are already charitable. Let's say, for example, that you donate $10,000 a year and you're in your early 70s. So what we would look at doing is basically funding the rest of your life in contributions in there. So let's say, for example, it's 150,000 with market growth. That's going to pay out for everything through age 90 on that. You would throw 150 grand into this account and use that in conjunction with the Roth conversion to really bring down that lifetime tax. There's a lot of moving parts with this. So the main takeaways that I see are, one, what's the benefit? The charity continues to get the benefit no matter what. That's first and foremost. But we're being a little bit more strategic about this so that, yes, the charity's getting their money, but we're also receiving a little bit of a write-off on our end as well. Two, we get to avoid that capital gain. Again, charities do not pay those taxes. And three, when we can use that with what's also going on with your financial plan, it can mean for meaningful tax deductions for you and your family. You get the tax benefit the year that you make that contribution into that DAF or donor advised fund, and it's you as the donor who gets the tax benefits on that. Going forward with any distributions, you have complete flexibility on that, and we're not worried about that from a tax write-off perspective. It is all about the year that we put that into that irrevocable special account or the donor advised fund. So here's the bottom line. Generosity is incredible, but generosity with a strategy is truly powerful. A donor advised fund helps bridge that gap. When done correctly, you get the tax benefit when your income is the highest, your money grows tax-free while you decide where it goes, and your favorite causes get every penny you intended for them. It's a true win-win for everyone involved. Now, this strategy sounds simple on paper, but it really comes to life when running the actual numbers against your specific tax situation. If you're curious on how a coordinated giving plan can work in tandem with your overall financial plan, our contact information is right below in the description. I promise there's no forums, there's no pitch, we're just having a conversation. If you found this valuable, we break down advanced wealth and tax strategies all the time, so be sure to hit subscribe so you don't miss out. I'm Jared Daniels with Roth Wealth. Thanks for watching, and we'll see you in the next video.